Hello and welcome to NoCast by CMUBS, the podcast where knowledge meets inspiration. I'm your host, and I'm here to take you on a journey through ideas, insights, and stories that shape the world of business, research, and innovation. Each episode, we bring you thoughtful conversations, practical wisdom, and perspectives from experts and changemakers. Whether you're a student, a researcher, or simply someone who loves learning, this is your space to explore, grow, and stay inspired. Thank you for tuning in. Let's dive into today's episode and discover something worth knowing.
You know, what if doing the right thing was actually bad for business? It sounds crazy, right? But that's the big controversial question we're tackling today with ESG investing. We're going to see what the data really tells us. So for years, we've heard this story, right? That investing with your conscience is the smartest financial move you can make. It's been pitched as this perfect win-win. But is it really that simple? Is that the whole picture? Let's peel back some of those layers and find out. And look, the promise is super appealing. I mean, who wouldn't want this? The idea is that these sustainable companies are just better. They're better at managing risk. They pull in all the modern investors. They get this shiny reputation and, here's the kicker, they're supposed to make you more money. It sounds perfect. It's the perfect formula, on paper at least. And believe me, this idea has completely reshaped how companies and markets think all around the globe. But you know, what happens when you cut through all the noise and just look at the cold, hard numbers? Well, a new study did just that. They picked a really high-stakes market to see if this whole promise actually holds up when the pressure's really on. And for this reality check, we're heading over to Singapore. We're diving deep into its huge real estate sector. Okay, so Singapore's real estate market, it is an absolute powerhouse. Just look at this chart. That black line for Singapore is consistently right there with and often beating the global average. So we're not talking about some small-time market here. This is the big leagues. It's the perfect place to put ESG to the ultimate test. And just so we're all on the same page, when we say REITs, think of them as the giants of the property world. These are the companies that own all the big stuff, the office buildings, the shopping malls, the data centers, basically the bones of our cities. So how'd the researchers figure all this out? Well, they went full-on detective mode. They looked at 26 of these big REITs over a 5-year period. And here's the smart part. They didn't just listen to what the companies claimed about being green or good. Nope. They used objective, public ESG scores from a third party. They wanted the real story. All right, so after all that digging, what did they find? Well, let's just say it wasn't what anyone expected. Okay, get ready for this. The universal expectation, right, is that a high ESG score means the company is worth more. But this study, it found the complete opposite. Higher ESG scores were linked to lower company value. Yeah, you heard me right. Lower. And this table just lays it all out, plain and simple. Look at that top row. Firm valuation, straight up negative. And everything else investors really care about? Stock returns, how efficient the company is. Nothing. No effect. All those promised financial benefits? Poof. Gone. Okay, but hold on. Maybe we're looking at this the wrong way. One of the huge promises of ESG is that it's supposed to be like a shield, right? It protects a company when times get tough. So let's see if that's true. Does it actually work in a storm? And you might be thinking, well, maybe that one big ESG score is misleading. That's a fair point. So what happens if we break it down, into the E, the S, and the G separately? Well, even when you slice it up, the results are kind of meh. The E for environmental, absolutely no impact anywhere. The S and G show these tiny little positive sparks in a couple of places, but there is no big consistent win. It's not the game changer we were told it would be. And this is where it gets really weird. It's like a student who keeps getting better and better grades, but their allowance just never goes up. You can see it on these charts. Companies are definitely trying harder, their ESG scores are going up, but for investors, the financial reward just isn't there. All right, let's circle back to that shield idea. The whole pitch is that ESG makes a company more resilient. So let's ask it directly. Does a high ESG score actually help a company survive a crisis? Like a pandemic or major market uncertainty? And the results are honestly shocking. When there was a lot of uncertainty around climate policy, the high ESG companies actually did worse. Their value dropped more. And during the COVID-19 pandemic, That ESG commitment offered literally zero protection. The shield, it just wasn't there when they needed it. So, what in the world is going on? How can this be? This flies in the face of everything we've heard about ESG for years. Well, the study has a theory, and it's a powerful one. It's called the overinvestment hypothesis. And this quote from the paper just nails it. It basically says this ESG efforts are costing shareholders money, but they aren't actually saving the company money or making it any less risky. It's all cost, no benefit. Okay, so here's the core idea. The hypothesis is that maybe companies are just throwing money at ESG stuff to tick a box for the government or just to look good in their annual report. There's no real strategy behind it to make money. It's overinvesting in reputation, and that could be actively hurting the company and its investors. And this might be why. The study suggests there's a huge difference between markets. In the US and Europe, ESG is often baked into the company's strategy. It's meant to create value. But in a place like Singapore, it seems it's more about just following the rules that come from the top. Think of it like this. It's the difference between playing to win versus just playing not to get a penalty. Now look, none of this means that ESG is useless. Not at all. But it definitely means we have to rethink what we mean by good business when we talk about this stuff. So what's the bottom line? The research gives us two really clear takeaways. First, for managers, if you're going to do an ESG project, it needs to have a real financial point to it, not just be about taking a box. And second, for all you investors out there, a high ESG score is not a golden ticket. You've still got to do your homework and look at the company's actual fundamentals. And that leaves us with one last really big question to chew on. This whole study was about financial return. But if doing good doesn't always make you more money, then it forces us to ask, what's the real point? Is profit the only thing that matters? Or are there other things we should be valuing? That's a big one, and something we should all probably think about.
Thank you for joining us on NoCast by CMUBS. We hope today's episode sparked new ideas and inspired your next steps. If you enjoyed this conversation, don't forget to follow our podcast and stay connected so you won't miss the insights, stories, and meaningful discussions coming up next. Until then, keep learning, keep exploring, and see you in the next episode.